Big picture analysis. U.S. stock market. Extended rally tops yesterday and today. So when I do videos like this, it's a tough balancing act for me. I want to be a realist, not an alarmist or an extremist or a doomsayer. It means doing my analysis and presenting it in a level-headed manner and still not minimizing when I see extremes. So that kind of brought me to where I am right now as I met the challenge this morning as I was doing this research. And it was very apparent to me that we were in an unusual condition, yet not so unusual that it doesn't have a historical basis from which to do analysis. So when I started this video, I really was thinking a lot about that. How do I present this in a way that is very much realistic, that is supported by, a historical basis, and that can give investors a heads up, essentially, or traders a heads up for what is the highest probability going forward. So when I look at big picture analysis, I always look to the monthly charts. Sometimes I take a deeper dive and look into weekly and daily charts, and not this time. This time because I'm looking at secular bull markets and following periods after those. It meant that I had to go back and I had to look at the monthly charts and stick on those. So what I was looking at today, and where my focus clearly was when do we see an extreme like this? When have we seen that in the past? Part of what sent me to do this is that I've gotten a number of emails recently that people say, what is going on? This market just does not want to go down. It just keeps going up. I don't understand a market like this. Some of them are investors that have missed it. Some of them are investors that are in it and wondering what they should do. And some of those are people that are traders and are really struggling because this is not a trader's market, for the stock market at least, because traders need two-sided action, and you don't really have that going on right now. So I really wanted to look at this and get a good feel for what the historical basis was, what does it mean, and what followed after these periods. It meant really getting a good look at periods, what the duration of move was, and breaking it down into cycles, a little different kind of a cycle than you've seen before, because what I wanted to look at is the long moves in the markets. And what I looked at was the secular moves. In other words, when markets moved up for a long period of time and had little cyclical movements up and down, bulls and bears within the major secular bull markets. Well, why did I focus on that? And well, that's because this is a secular bull market now that's approaching 11 years old, with that low coming in early 2009. So pretty close to 11 years old right now. So I wanted to factor in the late secular bull market situations. It doesn't make sense to be looking at major secular bottoms because those numbers are going to be very different. You easily get very, very strong moves off of secular bottoms, and that's not where we are right now. So some people might make an argument that the rally that we have right now going on is not really that long. Presently, off of its correction low in 2018, it's 13 months old. And it's had a very significant gain in there from that period. Well, let's call it a huge 44% from that low 13 months ago. Now, again, that might not be that rare when it comes to a secular bottom, but when it comes to long markets where you're well into a secular bull market, that is significant. And that's what we're going to focus on. I hope that was clear, you understand that. Since World War II, we are now in the sixth secular bull market. 5 in the past that we're going to look at that began really 1949-ish. all the way through today. And I've got the numbers all laid out for you, and I want you to really see what has been going on, and you can make some decisions on your own, and certainly I think I'm going to influence those decisions. And you can go back and look at this analysis and maybe use this to tune in your own investing and trading for your longer term holdings. And I have a feeling that it might get you to start changing some allocations on longer term holdings as we look at this. So let's focus in on the monthly chart of the S&P 500. Let me tell you what we're looking at in here. So back over here is the 49 low. And this is the secular bull market in here. Now this takes you to the 1962 peak over here. So 49 to 62. That's approximately a 13-year secular bull market back then. Now what we want to focus in on is the final rally in here, because this is the last rally in the secular bull before a bear market hit. And this duration of this is what's significant, both in time and in price, in the amount of a percentage that it gained. And then we want to look at the bear market that followed afterwards and just get a sense for that also. So secular bull, final rally in here, and you can get a little help in here. You see the slim ribbon right there. Now the slim ribbon, I tell you, and I certainly believe, is the best momentum indicator out there. And you can see in here where it had bullish momentum signals, how long those lasted. For more than a year, maybe 2 years, on many of these cyclical bull moves. So you have a cyclical bull move here and here. These things averaged about 53 months or so. This one was much longer in that time frame. And the final rally right over here in this secular bull was 13 months. It went 38%. The bear market was about 19 months, and it fell about 29%. So what we're going to do is we're going to move forward and make these comparisons. And you want to look at this. Final rally, 13 months, gained about 38%. So now let's go up here and look at the next secular bull market in here. So what we're looking at in here is the 1962 low to the 1973 peak. And there again, you can see, well, there were basically 3 cyclical bull and bear markets in there, and the final one was the big break in here. Now here is your last corrective low right here, and we pointed that out, and your final move from that last correction is this one right in here. It was 13 months again, this time 27%. The bear was 19 months old. It was 51% was the loss in there, and that was the Nixon resignation, the whole huge Watergate affair, and the oil crisis, where we saw the Saudi and the oil countries putting the squeeze on the U.S. And we had this big bear market in there, 51%. Again, this is the key right in here that we're looking at. 13 months, 27% rally. The final secular rally, and from that secular bull, and it took you to a period of about 12 years. So in other words, 12 years from that low up till here, a final rally in here of 13 months, 27%. This, you can see, and as you do this analysis, is going to become a common occurrence. This is when investors throw all their money in. They just can't miss that last move, and you get big moves. 27% you're going to find is one of the smaller ones in there for the final move. So now we're going to advance this again and go to the next secular bull. Now this one is unusual in some way, in that the secular bull in here rallied from that low in 75 up to the peak in 87. So again, it was a 12-year secular bull. Again, it had 1, 2, and a very long third cycle. This was a very big, long rally in here. The final move in here is where we want to focus, of course. And you'll note that that bear market was very short. It was only 3 months long and lost 35%. This final move from right here, and note that the slim ribbon was just bullish the whole time in there, from that low right over here to the peak right over here, was 11 months, 47%. Now you're starting to get the similarity. We had a 14-month, a 13-month, and an 11-month final move. Again, the investors have to get their money in here, and you get that big move, secular bull, very old. Final move in here, pretty similar in length to what we've showed you, and then it gives it up right over here. This was a panic in here based, and I don't think enough people give it credit for the portfolio insurance situation. There were just a huge amount of funds that were involved in that portfolio insurance. And the what happened was that because they were all so stuck, they were selling S&P futures, the big ones. I know because I was trading in the pit at the time, at massive discounts. Just had to hedge off their risk, and that caused that big break right in there. And of course, it was very primed for it. A very risky period after that big final move to the upside of 47%. This gets a little bit funky in here as we go from that bull market there that started after that 87 crash and goes either for a 13-year period or a 19-year period. You can see the double top there, and we're looking at these two peaks in there. And what's really interesting is that we still have similar situations from which to measure. Whether it's from here or here, it doesn't make any sense that the secular bull started here when this made a lower low in 2008, 2009. So this seems like it's all together in a very extended period of 19 years in this secular bull market. So it doesn't matter how you measure it. What we're really looking at right over here are these final two moves on the upside right in here. This one, the final rally, 11 months and 25%. You're getting the similarities in here, right? You see that 11 months and 25%? The bear market that followed was 27 months and a 50% loss. This one, off the second top right over here. And remember, this was the .com or .bomb crisis where you got to huge valuations. Now, I want to consider this as an extreme valuation period in here. You know what those PEs were back there in 2000. The valuations were less so over here because the market had time for more earnings to build up. Now, I'm going to talk about valuations in a little bit, and you're going to see how important that discussion is. So again, you can see the slim ribbon bearish here and the collapse, the slim ribbon bearish here and the collapse. And this one, a final rally of 15 months and 29%. You can see that right there. So this one, 25%, 11 months. This one, 15 months and 29%. And your bear followed at 17 months and a 57% loss. The financial crisis right over here. This was the mortgage crisis, the financial crisis. All of this, of course, I'm not talking too much about what caused that. We're talking about technical stuff. But all of this caused by Greenspan, who created the activist Fed and pushed interest rates all the way down to extremely low periods and extremely low levels for long periods of time. Did that right over here. Bernanke took over and he did that right over here. They pushed interest rates down to 1.25%, 1%, and held it there for 18 months. And QE and everything else. And that's what sets up the difficult situation we're in right now. So this is the present secular bull market. And again, you're going to see the similarities. And I'm going to move over to another chart from this point on and give you a little more detail on this. So this is the secular bull market we're in right now. It bottoms in early 2009. Here we are in early 2020. We're 11 years old so far. That you would say that's relatively short, and that could make a case for the bull market not being over. Still, there is a good reason to be looking at this final move right in here, and that is 14 months, 44% so far from this low. So by every extreme that we have measured, this is setting up for something pretty sizable on the downside. Is 11 years enough for a secular bull? Well, the question is, does it have to go more? But remember, it's following 19 years right over here. It seems to me it could be shorter to make up for that extreme, but that's just me speculating. I'm not sure about that. I'll show you some things on the next chart. So again, we have 14 months, 44% in this rally, 11 years into the secular bull. That makes a case for something pretty significant coming after this top on the downside. The bear market that I have projected that I will show you goes to mid-2022. The estimated loss based on everything I just showed you when secular bulls end is over 30%, all the way up to 57%. Right, so the average is probably in the 35% category. So this stock market, sometime in the next couple of years, is going to have a bear market that loses 1/3 of its value. It's routine. It's everything that I've shown you in here, all the way back to World War II. The hubris of the Federal Reserve might think that they can end the business cycle just through their QE programs, and they said now, Powell said he'll do QE basically till your eyes bleed from this point on, just to battle the next recession. Well, maybe he could do that, but it's not going to prevent the next major bear market. So that's our projections right now, and let's just take a look and see where they come from in here. So here is me breaking down that this secular bull market into its cyclical components in here that you see. And you can see we have the major harmonic families in here. There's a 20-month, which is the minor one right in here, and the 40-month, which is the middle-sized one or the intermediate, and the 80-month right there. And you can see how that aligns right over here and then projects out over here into the summer or late spring of 2022. So we're in this rally right now, right in here. And this minor correction is the one that's due. Now, what I have projected is an 8 to 12% drop. If it dropped from here, it would be to 3,000 down to about 28.75 in this minor corrective period. If it was deeper than that, it probably would be setting a bull market top in here. There are two scenarios in here that you could look at, and that is that, well, we're just going to, off of this extreme that we are right now, we are only going to get this modest correction right in here and come down only to, like, let's say 3,000 over here. We lose, a modest 8-9% on the downside in here. It's not even a real correction, to tell you the truth. And then we rally up to a new high right over here. If we did that, it would make the secular bull lasting something like close to 13 years. Something like those other ones that we looked at in here. If it could make a double top, it could, make a significant new peak up to 3,500 up here at the major extension target. Truthfully, I don't know how to project this right over here. This whole big picture analysis right now is really about where we are right now and the likelihood of this break right over here in towards the election time right over here. Now, again, I have been talking about the surge of the Democrats and that the stock market is not going to like the prospects of Bernie Sanders or Elizabeth Warren or anybody that has a socialistic bent. They're not going to like that, and that might be the setup for this right over here. I don't know what would cause this rally or this rally. I mean, you have to be a fortune teller to tell that. I'm just reading the cycles in here, is what is the most obvious to me and the highest probability. And that is that this last move that we're in has reached its level of massive extension, and that we're likely to roll over and get a correction here in towards the fall, right over here. This is late summer, August, July, somewhere in there, and then get some kind of an additional rally, either to another bull market top or a secondary rally in what will have been the beginning of a bear market that comes down and loses about a third of its value here out into 2022. So I've turned this into, looking at historical period, or turning it into hysterics, take your choice. Looking and projecting out things that I've looked at before. We really don't know. This is the most obvious thing to me, is this peak and the break into the late summer, early fall over here. And I don't think there's much more. I've been saying I only thought there was about 1% possibility on the upside, and now we've gotten that 1% on the upside since I said that. So we're at a very extreme period right now as we look at that. So secular bull market that we're looking at right in here at an extreme, 44% from that last correction right there, 14-month rally. It hardly lasts longer than that, and then you get a pretty good correction. Bull market peak, I don't know. A cyclical peak right in here where we're getting this minor cycle peak, I think it's a very high probability, and that you get another rally after that into next year, and then a bear market into May to July of 2022. Secular bull market, 11 years old in here, and getting really old when you look at that. So we looked at a lot right in here, right? It's making a case for this bull market being old. But what about valuations? This was based on historical lengths, and you could make the case that it lasts a little while longer. But what about valuations? I want to look at the Buffett indicator, or a variant of the Buffett indicator. And what the Buffett indicator does is it looks at the GDP and looks at market cap, and it's just a ratio of market cap to GDP. Now, I talked about the valuations in 2000 that were extraordinarily high, and that they weren't quite as high in 2007, but we still had the financial crisis. Well, let's take a look at this chart right over here, which is a variant of the Buffett indicator. I want to thank Advisor Perspectives for putting out this chart, which is the Wilshire 5000 to GDP. Why I like this better is because, well, it's 10 times the size of the number of stocks in the S&P 500, so it gives you a better idea. And you can see in here in 1987, when the crash came, the ratio was only at about 63%. When in 2000, when the peak came before the dot-bomb crash, the ratio, it was 163%, the valuation of the Wilshire versus the GDP. Here we are in 2007 at about 105%. These are really excessive numbers. Of course, 2000 crazy. Well, if 2000 was crazy, what do you call 2020? We're now over 145% of the ratio of the Wilshire 500 to the GDP. This is an extraordinary thing. You can blame the craziness of what's going on right now, of every investor being afraid to miss this, this next extension of this bull market, funds pouring in. So you can see this is nutty, what we have in here. When the bear market hits, I'm not saying it ending today, right? When it does, it's going to come down in a big way, and I showed you, I made that case. The recovery after that is likely, and then, it could be a long time before you fully recover out of that. But the Fed is stuck right over here. I mean, here we are. When they broke the market here, you had interest rates much higher, and here we are at interest rates. This was in the 5-6% area as they were tightening in here. The same thing in here, but now when we had the break in December of 18, where I measured the low from, it's because they pushed rates up to 2.5%. So right now the Fed is completely stuck. I think that when we have the big break or the next big break, it's going to be because the Fed got stuck. They created this nightmare that we have right over here, and that we are not likely to be able to get out of very quickly. I think history will show that the next big break in the market, and the reason we got to these crazy valuations, is simply because the Fed lost its cumulative mind. Here we are at some 145% to GDP, and the stock market is at a absolutely crazy valuation. Don't tell me that 2000 was a crazy valuation, and you don't tell me that we have that going on right over here. So essentially what I'm doing is, giving you the warning, if you want to think about this and think about your own allocations, it sure makes sense to me to do that, because the Fed has lost its cumulative mind. You can see that right here. That's it for this video. I hope you found it valuable and informative, and that in the long run, it does something to really help you save a potential big hit from your investments. That's it, and I will see you in the next segment.